So the venture capital method was set up by a professor at Harvard Business School who decided that for companies that don't have a track record of financials, they don't have historical statements with which we can analyse and create DCF valuations, which we can do for listed companies. Instead, he realised that one way to analyse and value a startup is to look at what the value of the startup will be on its exit, maybe in 3 to 5 years. Look at the investors along the way who come in and have their own return on investment requirements, and then use the concept of compounding and discounting to calculate the value in today's terms of their investments. So for our case study startup, we're going to look at CityDine. It's a dining app to help foodies find the most trending restaurants by location. So in order to run a venture capital method valuation, we actually have to make a few assumptions about the company and the investor. So let's look at those about the company. So firstly, we need to understand the time period with which the investors and the founders want to run the business until exit. So we're going to assume that CityDine's founders want to exit the business in 5 years. The founders also expect to generate £2.5 million in sales in year 5. Our comparable listed companies set within the food and retail industry are valued at 20 times price to earnings. It looks at its comparable listed companies and it's determined that the company can make 15% profit margin, which is the equivalent of £375,000 in annual profit in year 5. And CityDine was incorporated when it first started. Between its founders, it set up and created 100,000 shares. So we're going to look at 3 different financing rounds and the valuation of the company at each stage. We know that as investors come in at earlier stages, they may decide to make smaller investments in the company, but because they're investing at an earlier stage, when the risks are much higher, they require a higher rate of return. So we can see for the angels, the first investors in our 3 financing rounds, that they require a return of 50%. In year 2, as the business progresses and grows, and the risks become less and less, the company's investors can only demand a smaller or lower rate of return on their investment for a higher amount of investment made. So we can see the investment's growing, but our required rate of return by the investors are falling. So a question for you is, what is CityDine's value on exit in year 5? Is it A, £2.5 million, B, £7.5 million, or C, £375,000?